Wealth building doesn't happen overnight. It takes years and decades of building money. So wealth preservation is way important than creating wealth. Rich client versus the average commoner. There are two distinct thought processes. Average people, we look at returns, whereas on the other hand, an HNI has a very different mindset. His thought process is
times that there's market uncertainty. What is it like when it comes to the HNIs? How do they react?
Deepak Wazrani is a senior advisor to family office clients with nearly 30 years of experience in banking and wealth management. He has held leadership roles at firms like Religare Macquarie and Standard Chartered Bank. In this interview, he shared how HNIs, which stands for high net worth individuals, in simple terms, ultra rich people think about money and what retail investors can learn from them.
Family office has a very different mindset. His thought process is how do I create value from money? For him, it's a tool, not a goal to create money. He looks at how actually can my money work for me? How can I leverage this and make it grow? How can I preserve this wealth? Wealth preservation is extremely critical because an average client and an average normal person like us, we want to create wealth. We want to make money. Here, the wealth is already created. How do I preserve wealth so that it can be passed on as a legacy for the next generations? How do I preserve money? How do I pass it on in a very strategic way to the next generation? How do I diversify my asset class so that it plays out during all market cycles? During market downturns. So that's the mindset that HNI typically looks at. How do I, make it more tax efficient? By creating
and
that.
I think everyone looks at it.
All of us. But over long-term planning, over a more diversified approach on investment planning, I think you cover all aspects of that. So I think it's more of unlocking the value. It's already.
In this segment, the interviewer asks him, have you observed any specific beliefs, behaviors, or temperaments that are common among ultra high net worth individuals or the wealthy people? Let's hear his response now.
They have similar behavioral patterns. If I tell you, Aman, right from the word go, they pick up opportunities very early. They have all come from an entrepreneurial mindset, right? So they're all business owners, they're all promoters. So they understand a risk-taking ability. They understand risk very, very closely. Right? So they are ready to take those risks in their investments. It's a very structured and very methodical approach. They're very calculated risk, I should call them, right? So they do that. They understand that they have to pick up at early stage. If you ask me, when I sit with a client, he will ensure his son or daughter will sit to understand how a portfolio is structured. So that pass on happens very early at a very early age. So they want to ensure the second generation or the third generation, I call it, is completely engraved in this process. So that is the behavioral pattern, I see among HNI clients. I see a lot of, clients look at opportunities, how they can leverage on to optimize their wealth. So if you see, they have a lot of real assets. If their real estate is a large part of the client's portfolio always, how can they optimize that to the best possible manner? How they can leverage that and get a delta in the portfolio? How they can spot opportunities, maybe investing in a good startup. But what I've largely seen is they all believe that liquidity is the key. So if you you'll be surprised if I tell you they are large. So that pass on invested, but a large portion of their wealth is always in liquid assets, which can be liquidated when they spot an opportunity.
Let's take a pause here because this is very important and most of the retail investors get this wrong. They either invest all their money at once or they don't invest at all. And when something big happens in the market, like a crash or correction, they panic. They have no cash left to buy more and they feel stuck. Some even blame themselves or the people who told them to invest. But wealthy people handle it differently. They always keep some money aside just in case the market drops. That way, when prices go down, they can buy great stocks at cheaper prices. Even Warren Buffett says that big opportunities don't come often. But when they do, you do need to be ready to invest big. In fact, most millionaires are made during market crashes and corrections. People who understands how the market moves and who stay calm when others are scared usually end up winning big in the long run. Deepak was also asked on how often do you meet the clients and what are the questions presented and who is there for the meeting. Let's hear him out.
So the client is always there for the meeting. He's always ready for the meeting. They see they understand money. They understand the importance of advice. So they always want to know what's happening in the market. So again, like I said, the portfolio reviews that happen, we call them portfolio. It could be a quarterly review, and we don't talk about the review because when we start a portfolio, it is after several meetings of understanding the financial objectives, their long-term, short-term goals. We create a portfolio. So when we sit down with them on a review, it either happens a quarter or a 6-monthly or a yearly review, depending on their time because they're always traveling, they're always busy. But largely, what I've seen seen is the client himself is present in most of the cases.
Okay.
Where he is very busy, where he's not able to give his time, he has a committee that he set up.
Okay.
Investment committee, which is his core committee. So you run down that presentation of the portfolio with this committee, we discuss, and the final decision is taken by the client himself.
Okay.
So that is very clear.
Okay.
So all of them are very clear they want to be involved because it's money end of the day. It's a hard-earned money. So while we advise them, the final decision is always made by the client.
But the committee is privy to all of the
Absolutely.
decisions, the money, where it's going.
So where the client is extremely large and he is always on the go, on the move, traveling, constantly on overseas, has overseas travels, there is a committee which is formed, and they are well aware of what the process and the investments are happening. So we run it down with them, and finally, we run it with the client as well when he has the time, and the decisions are taken accordingly for fresh investments, fresh inflows, all of that. Otherwise, the client is always present.
Okay.
He always believes he has to be there. He always will also ensure one of his children is always there, part of the decision, so that that gets inculcated at a very early age for him. He
Yeah,
understands.
that's so critical.
Yeah.
Here's another important point most people miss. Wealthy families start teaching their kids about money very early in life. That's one big reason why their kids grew up with business mindset, and many of them end up becoming entrepreneurs or successful investors. But in many families, parents avoid talking about money. If kids ask questions, they are told things like, "Why do you care?" or "You'll understand when you grow up." And the truth is, schools and colleges rarely teach us the most important money skills. Nobody teaches us how the real world works, how to manage your money, or how to invest smartly. So, what happens? People only learn these things after making painful mistakes, and by the time they understand, it often feels too late to build real wealth. That's why we need to change the mindset. Start teaching your kids early about investing and saving and understanding the value of money. If we prepare them now, we are giving them a massive head start in life. All right, now comes the most important question to Deepak. During times of uncertainty or volatility, or if there's a global event, for example, a lot of us will have knee jerk reaction. What is it like when it comes to the HNIs? How do they react? Are they unfazed or are they hot and bothered? What is their temperamental behavior? Let's see what he says about that.
Yeah.
So what you'll be actually amazed for a common man, for a normal person, when the market goes through a downturn or when there's a volatility or there's a global event that happens, that plays out, we get really jittered, we get shaken, there's always a knee jerk, we want to exit, we want to save money, we want to kind of come out, we talk to our friends, what they do is, now I'll tell you what they do. They have, like I said, I mentioned in my earlier conversation, they have a lot of liquid cash available in their books.
Yeah.
They look at it as an opportunity because they look at long-term investments.
Yes.
They look at long-term planning, and they know there'll be cyclical events that will come. In fact, I'll give you a small, data. I remember in 2008 when the market was 21,000, and it fell right up to 8,000 Sensex. Right? If you see the trend of FIs, the FIs will start pumping in money when the markets are at all-time low. The HNS will come later, and then when the market has already had a run-up of 30-40%. At least 30% upside, the retail investors are coming in. Where they've already gained up 30% upside, 40% upside. And when the market touches the 30, 40, 50%, it'll of course correct. So they have only gained a 10% upside, and they go start downward correction, whereas these guys will already start booking profits and coming in. So it runs on like fear and greed. The market runs on that. They understand all of that very well. Most of these guys I'm talking about, most of the clients that I'm talking about, will take opportunity, sees it as an opportunity.
One thing rich investors understand really well is the fear and greed index. And even on this channel, I talk about it often because it's a powerful tool. I personally check the fear and greed index almost every day to get a feel for market sentiment. It helps me understand whether people are too greedy or too fearful, and that gives clues about what might come next. Along with that, I also track VIX, also known as the volatility index. It shows us how much fear is in the market and helps me decide whether to go in for a short term trade or stay long term. If you want to invest like pros, start following these indicators. They are simple, free, and can make a huge difference in how you manage risk and opportunity.
So if you see 2020, when we went through the worst possible phase of COVID, this was actually something which was completely, nobody understood how the magnitude of this event is going to pan out, right? So play out, right? So
a black swan event.
One in a century, right? What actually happened? You see a lot of transactions in real estate happened then. A lot of luxury buying happened then because it came at dirt cheap prices. How was it possible? Because they knew that the prices have gone rock bottom. They had liquidity available, though the businesses, everything went for a slowdown. But like I said, they have liquid cash available. They took it as an opportunity. So a lot of transactions happened.
Also asked about, was there any unconventional spending habit did he observe among rich people? Let's see what he says.
Liquid, because you don't know. See, we live in a very dynamic environment.
Yes.
You don't know what's going to come and hit me in the next 3 years or 5 years. We live in a very rapidly changing environment. Things are changing. With AI coming in, technology coming in, disruptions are happening very often. When that happens, and when we go through market cycles, we spot opportunities in that. That time, if I don't have liquidity with me, I may end up losing the opportunity. So they always, if you see Warren Buffett and Jeff Bezos, if I give you two big names, they're sitting on large amounts of cash. A lot of the HNIs back here as well have a huge amount of liquidity available because when they
I totally agree with this because we all know Buffett is sitting on a huge amounts of cash, around $334 billion. And if anything to happen to stock market like recession, he will take full advantage of that. We as a retail investors should also learn to be ready.
see a market downturn, they see a cycle which is down, they see a spot an opportunity, they'll immediately go and pick it up. They'll invest. That's the key. So liquidity is there. And plus, they always believe in optimizing the assets. So if they have real estate assets, they will borrow from that at a 7-8%, leverage, get invest into other assets which generate about 18% yield or 10% is what they make as a spread. So they're very smart. They optimize, they monetize their assets, they optimize. That's how they optimize their wealth, right? So, but one pattern I've seen, very unconventional pattern, is they want to keep cash available with them always.
Here's an interesting question Deepak was asked, and it's about the perception people have about generational wealth. Usually, the first generation builds the wealth, second generation builds on the wealth, and the third generation destroys the wealth. Does this really hold true in your experience? Let's see what he says.
Most of the times.
Really?
Most of the times, what I've seen. The first generation, who's built wealth, who understands the value of money. The second generation, if I have to see, because I've been with a couple of generational entrepreneurs, and I've had the privilege to work with them. What I see is the first generation is extremely passionate. They're frugal. They understand. They've toiled hard to build an empire, wealth.
It's from rags to riches, generally.
Absolutely from scratch, okay, from ground zero.
Yeah.
The generation two, the second generation, has seen their parents working really hard and growing the business. So they want to maintain that standard. They want to maintain that. So I have seen the second generation and most of the promoter families, they want to grow that legacy and build onto and catch onto it and leverage on that, build it bigger. Most of the times I've seen, the person is not as competent as the father was, as ambitious as the father was. So he wants to maintain that at least. The third generation, unfortunately, has been born into wealth.
With a silver spoon.
With a diamond spoon, you may say. Yeah. He has not seen any setbacks. He's not seen any problems. He's not seen any turmoil in his life. So he is the one, if he's not kind of explain the importance and relevance of wealth, if he's not, being groomed in the right way, that happens, that generation actually destroys the wealth. He doesn't forget stabilizing the wealth, he'll destroy the wealth. If not rightly shown the path, if not rightly conditioned to take it forward.
And the last question in this interview he was asked was, what have been some of the key learnings you have got from rich people that you now implement in your wealth creation advice? Let's hear him out.
I think be patient.
Okay.
Look at long-term planning, keep long-term objectives into play. When you look at investments, look at long-term always. Look at a very diversified portfolio because you will have all market cycles across every asset class that will play out. And number three, always stay a bit in cash and liquid because you never know what opportunities come next. And how you can capitalize on those opportunities and grow your wealth exponentially.
Okay.
My three takeaways.
He talked a lot about the importance of always keeping liquid cash, and honestly, that really resonated with me because it's exactly why I keep my own portfolio 50% in cash and only 50% invested. Now, I know that might sound too conservative to some. I even had some people tell me, isn't 50% in cash too much? You're missing out on the rally, you're only making pennies in interest. But here's my perspective. I've lived through the pain of being fully invested when COVID hit. My portfolio dropped more than 50%, and the worst part is I had no cash on hand to buy the dip. I had to watch all those opportunities pass me by. So, yes, I'm okay with missing a small part of the rally because I'm preparing for the next big opportunity. And here on this channel, I don't just show my investments, I show my cash position too because I want to highlight how important it is to have the dry powder ready. A lot of people only talk about the gains, but wealthy people, they talk about the risk. They protect their capital and they always make sure they are ready for whatever life or the market throws at them. Making money is important for everyone, but keeping your money safe and being ready to take action when opportunities comes, that's really what builds long-term wealth. I hope this video gave you something valuable to think about. If you watched this far, thank you very much. That means a lot. If you found it helpful, please give it a like, drop a comment with your thoughts or key takeaways and subscribe to the channel. It truly helps the channel grow and keeps me motivated to keep sharing honest, thoughtful content with you. As always, stay safe, stay mindful, and I'll see you in the next video.